Hi, Sebastian here from Wealth Depot. I just thought it'd be timely at this sort of juncture or where we're sitting in the current market cycle, just to probably start releasing some information and some insights into what we think the financial markets are doing at the moment. I'm receiving a lot of inquiries about opportunities and when we should be, I guess, planning to act on those opportunities in terms of, has the market bottomed out? Is there a way to go still? What are the stimulus measures? How are they impacting on any recovery, if any, or any confidence? I honestly believe there's a fair way to go yet. We're still a bit away from the lows of the GFC or other historical lows. So I see that we're definitely going to be heading just for a little bit more uncertainty, a little bit more volatility over the next couple of weeks as businesses especially start really contemplating the impact that the normal business trading cycles are going to have on their businesses. So I thought it'd just be wise just to shoot out a quick 1-2 minute update about where things are at. I'll try and send these out a little bit regularly over the next coming weeks and months, just to maintain some clarity about what is happening on the ground in the relevant markets. So this graph pretty much shows, what's been happening in the world economies over the recent period of time. We've obviously seen, global share markets decline from lofty highs coming off the back of 2019 to be sitting roughly an average around about 30-35% lower in valuation. I don't necessarily want to dwell on this. This is news that we do know, but it's just important to obviously take that in and just play it in the back of your mind and realize that unfortunately, no matter where we went or where we were invested, we weren't going to be immune to obviously to the symptoms of the far-reaching implications of the coronavirus and its implications on the world markets. What's been probably the hardest pill to swallow is that the actual retraction of the market has been the fastest in history or recorded history, dating back to 1929. There, the markets have just had significant what we call bear market reaction from the peaks experienced, like I said, back in 2019, and that's what's caused a lot of the early anxiety and stress around portfolios, and obviously positioning of portfolios. That the fall was quite strong and fast, which didn't leave a lot of time to make significant decisions in a very short period of time. However, if we look at the US market and look at where we feel we are right now, obviously the US market is a pretty good indicator of most other developed markets in the world, including Australia. So what we're seeing here is that the pull down is probably alluding to what beta shares have described as a garden variety recession. Now, whether that's going to hold true or not, obviously we will discover over the coming weeks and months. But compared to some of the more recent downturns, especially back around the GFC, you can see that the ferocity and obviously the depth of the recession was very significant. And at the moment, all we're seeing is obviously more aligned to a technical recession, and there's no doubt that the recession is here and most likely to follow over the next quarter. But I guess these provide a little bit of hope that whatever is going to come will come, and hopefully we can recover sooner than later. But in terms of understanding what's important in these times is to understand that switching investment strategies without having careful understanding about your long-term goals around what's happening in your world today or tomorrow, we don't want to be making rash decisions. You know, we want to be making calm, collected, rational decisions based on fundamentals and based on our long-term objectives and investment philosophy. So this graph here, which talks about, you know, bear markets are painful, but markets rise over the long term. You know, shows that, you know, prior to the coronavirus sell-off, you know, there have been 8 market downturns since 1926, the most severe being the Great Depression. You know, the chart is based on a monthly return showing these rises and falls, and more recently, as the chart shows, the lost decade of the 2000s included 2 consecutive downturns with little to no expansion. The dot-com bust of 2000 and 2002 and the Great Recession of 2007 and 9 that discouraged investors. So at its lowest point, the market was returning negative 50.9%, but then it began to rising again, resulting in a total of 93 months of expansion that lasted through to the end of 2018. So we're just got to be mindful of these moments in history, moments in time, that staying the course and being true to your investment objectives is what will, you know, lead us through this, you know, very volatile period of time in the markets. This next slide here about market timing risk demonstrates that key point, that the effects of missing the best months of annual returns. That if you're not invested and you try and time the market about when to get in, when to get out, then you can see that, you know, there's significant drawdowns on anyone's portfolio when trying to achieve those, you know, very difficult moments in time. So that's what we've got to keep in mind as we sort of just work through these moments of pain and uncertainty. That selling down the portfolio and then trying to buy in at the right moment shows that, you know, we don't necessarily get it right. It's very difficult to get it right, and we don't want to be left with lower returns because of just you know, thinking that the best way to get out of this is to actually do something. Sometimes it's the best thing to do is nothing. You know, they will come and they will go. The next chart here talks about risk of stock market loss over time, and basically, you know, the most relevant points to consider out of this is that although stocks are sometimes considered risky investments, their long-term gains have been demonstrated to offset short-term losses. So the graph below in front of you illustrates the realized losses in the stock market for 1, 5, and 15-year periods, and it shows that of the 94 one-year periods since 1926, 25 have resulted in a loss. Of the 90 overlapping 5-year periods since 1926, only 12 have resulted in a loss. And of the 80 overlapping 15-year periods since 1926, none have resulted in loss. So even though like the first opening comment there was about stocks, you know, sometimes considered risky investments, the long-term gains have demonstrated that they will offset the short-term losses. Okay. So moving on to the sort of next slide here, we've got what we believe will be relevant in terms of understanding what's happening in the market cycles, and where we believe until we get post this point that we're going to just continue to have this ongoing cycle of you know, rising infection rates leading to reactive policy responses, leading to share market declines, leading to weak economic data, leading to weak corporate earnings, and this continual cycle. The only time the cycle is going to be disrupted, in our opinion, is that when we have falling infection rates, that's going to lead to some share market stabilization. It's going to lead to easing of policy restrictions. It's going to lead to improved economic data, and it's going to improve corporate earnings, and that's hopefully going to get us moving towards a more normal, you know, status quo, where we're going to feel a bit more confident. Businesses are going to start picking up. They're going to start bringing back employees. Employees are going to start having confidence about their own income positions and cash flow, and that's going to drive consumer spending. It's going to take time, but one of the key drivers is going to be definitely this falling infection rate, which, as we all know, is all going to be demonstrated through, you know, social distancing, self-isolation, and some of these strategies that the government are trying to impress on us at the moment to definitely reduce that curve. So the three most likely scenarios going forward, we've got the V, which is all about it's going to be over soon, to the U, which is the worst is almost over, but slow recovery ahead, and the L shape, which is the worst is yet to come. I mean, the V curve would be definitely the best scenario. Whether that's going to be likely or not will definitely resolve around whether the amazing medical profession that surrounds us globally can definitely come up with a vaccine to ensure that people are confident about their health, confident about their ability to return to work, and for business to regain that confidence to know that tomorrow they will earn $1 and be able to generate growth from that. The U curve is probably where we are going to sit, most likely, but it's going to take time, and that time could be 6 to 12 months. And it's all going to again depend on when that vaccine becomes available. The L curve, it's definitely not it's not an impossibility. The majority of analysts believe at the moment, and economists believe that due to the huge government stimulus and measures being taken, that prolonged recessionary position won't be too long lasting. The most likely outcome is 2 quarters of definitely negative economic growth. But again, time will tell. And last thing, I just want to leave us on what's driving our investment principles at the moment. These have been the core workings of what we believe here at Wealth Depot to be how the how and the why to invest. These are the core principles of our investment philosophy, and we aim to implement these across all our clients and our portfolios. So I just thought it'd be timely just to make sure that we all are thinking about these core principles as we journey along this uncertain and unprecedented times. But at the core, our investment philosophy is driven by investment principles that are promoted throughout our organization. So it's a big part of our value proposition. And the principles are intended to guide our behavior and rational decision making while honoring our history and investment approach. So, we always are going to be putting you first in terms of your needs, your objectives and strategies. We're independent minded, so we're not controlled by any particular way of investing. We do value investing as being a very core of the investment strategies, but we definitely aren't driven by any particular voice. We invest for the long term. That's obviously a key principle to a lot of our portfolios that we manage in terms of superannuation and just general investment strategies. We're value-driven investors, so we are looking for that price versus intrinsic value opportunity in all our investment decisions. We take a fundamental approach, so we are looking at the core drivers of business earnings and management plan for growth. So they have to be always at the forefront of any investment decision. We always strive to minimize costs, and as the data shows that percentage basis points in cost savings deliver better returns out in the long run. So we always have that at the forefront of our decisions, and we build portfolios holistically. So we're looking for diversification, dynamic asset allocation, where we can move in between asset classes based on long-term valuations in a timely manner. So we're building those diversified portfolios to provide when markets are hurting. There's other sort of strings in the portfolio that are going to help protect capital in those scenarios as much as possible. So I thought it'd be just good to recap on all those things. And as always, we will continue to provide the facts and trusted information to help you and your family make most informed financial decisions. That's our job. That's our role as your advisor. And we're definitely happy for you to share this information with family and friends, and we invite you to do so. And as always, we are always open to no obligation chats with anyone that may not be a client or even if yourself. Please don't hesitate to reach out and for us to help you with understanding some of the measures that have been announced through the governments, through be it state government, local government, and also federal, and to make sure that you are aware of those measures that can be maybe applicable to you. So thank you again for your time, and stay well and stay healthy, and take care. Bye bye.